Today we will be covering MaCRS depreciation. For the problem statement, there is an asset that costs $25,000 and has a useful life of 5 years. We must determine the depreciation charge for the 4th year using the MaCRS system. Now, what is the MaCRS method? MaCRS stands for Modified Accelerated Cost Recovery System. This was developed by the IRS, or Internal Revenue Service, to standardize the methods for asset depreciation on a tax return. Asset depreciation is necessary to determine the amount of money that can be deducted from your taxes due to the reduced or depreciated value of an asset, which is looked at as a loss because the value of the asset has been reduced or is less than what it originally was from the time it was purchased. To calculate the depreciated value of this 5-year life asset in the 4th year, we must look at the MaCRS table given by the IRS online. The MaCRS method of depreciation is broken down by the lifespan of the asset, which is 5-year, 3-year, 7-year, 10-year, 15, and 20 years. Now we are dealing with a 5-year life asset. So in the 1st year, the asset depreciates by 20%. In the 2nd year, it depreciates by 32%. In the 1st year, 19.2, and the 3rd year depreciates by 19.2, and in the 4th and 5th year, it depreciates by 11.52%. Now, to calculate the depreciation of the asset, we must first label the cost of the asset, which is $25,000, the lifespan, 5 years, and break down the depreciation rate by year. The percentage is written as a decimal for ease of using in Excel. So in the 1st year we have 20%, 2nd 32% or 0.32, 3rd year 19% or 0.92, 4th and 5th year 11.52%. Now to calculate the actual depreciation amount, or the amount that can be deducted from the tax return overall, we must take the initial value of the asset, which is $25,000, and multiply that by the sum, or the total percent depreciated over all of the years we're looking at, which we're looking at the 4th year. We must calculate the depreciation from year 1 all the way to 4. All the way to 4. So, all the way to the first 4 years of the asset. Now, the tool I used is the sum tool. Now remember to put in parentheses, that way it is understanding you're addressing an array of numbers. As shown, we have B2, the cell corresponding to the cost, multiplied by the sum of the depreciation per year, which is if we have the 1st year, 2nd year, 3rd year, and 4th year, as displayed by this array. Now, entering this, we have $20,680. The amount of money depreciated by this asset during the 4th year. This given example shows the amount of money the total amount of money that can be depreciated on a tax return to deduct from the profits due to the reduced value of the asset at this current point in time, or at the end of